Hi everyone! Today's video is about the summary for Chapter 1, Comparable Companies Analysis of this investment banking book. And this is the part 1 of the Chapter 1, and we're going to have several other parts following with this video. Agenda. First, we're going to have an introduction of what is comparable companies analysis. Then we're going to describe several steps, how to do it, and the key pros and cons, and finally a case study to illustrate how we're going to do this analysis. So comparable companies analysis, we also call it comparable companies trading comps or simply just comps. It is one of the primary methodologies used for valuing a given focused company, division, business, or collection of assets. We usually call it target. This analysis provides a market benchmark against which a banker can establish valuation for a private company or analyze a value for a public company at a given point in time. It has a broad range of applications, which mainly mergers and acquisitions, initial public offerings, restructurings, and investment decisions. Since similar companies share key business and financial characteristics, performance drivers, and risk, this comps analysis built on the assumption that similar companies provide a highly relevant reference point for valuing a given target. Therefore, the bankers can establish valuation parameters for the target by determining its relative positioning among their peers' companies. So the core of this analysis is to select universe of the comparable companies for the target. Peers are benchmarked against each other and the target based on various financial statistics, ratios, and valuation multiples. So valuation multiples means a measure of value of the target in numerator and their operating metrics in denominators. So we're going to discuss more about it, what are they and how to utilize those ratios, multiples later. So this comparables analysis is designed to reflect the current valuation based on prevailing market conditions and sentiments. So because market trading levels are sometimes subjective due to some irrational investor sentiment, so this can really skew valuation either too high or too low. And also, no two companies are the same, and this valuation can fail to accurately capture the true value of your target. So this comps analysis usually used together with other valuation methodologies like DCF we're going to discuss later in other chapters. And here are the 5 steps to do this analysis. 1. Select the universe of comparable companies. 2. Locate the necessary financial information. 3. Spread key statistics, ratios, and trading multiples. 4. Benchmark the comparable companies. And lastly, determine valuation. In order to select the universe of comparable companies, first we need to study the target and then identify key characteristics of the target for the comparison purposes, and finally we are able to screen the companies. So study the target. It is a process of learning the in-depth story of the target, and we need to read and study as much as possible for the company and sector specific materials. So it is important to know that the actual selection of comparable companies should only begin once this research is completed. So for the target, we have public targets and private targets. So for public targets, here are usually some where you can study and learn more about them. 10K, 10Q, consensus research estimates, different research report, press releases, earnings call transcripts, investor presentations, and their corporate website. And for the private target, it's usually more difficult to locate their information unless the companies have the public data. Here are some sources: their website, research report, news, journals, their public competitors, all this information if they have public competitors. And lastly, the bankers usually provided with detailed business and financial information in an organized merger and acquisition sales process. We're going to discuss later for mergers and acquisition. So after we study the target, we need to identify the key characteristics of the target for the comparison purposes. And we need to study their business profile and financial profile. Business profile. We need to learn about their sector. It's better for their subsectors because they convey key drivers, risks, and opportunities. And different sectors have different earnings volatilities and growth opportunities. For example, some cyclical or highly fragmented sectors will be completely different than the stable or consolidated sectors. The next is the products and services, they are the core of the business model. Some companies have both products and services, some only have products or only have services. And also some companies, their products or services are more diversified, others can be more focused. And within a given sector, comparable companies can be tiered according to their product and services in order to compare for the target we chose. And the next is the customers and end markets. So for similar customer base, they share similar opportunities and risks usually. And it is important to learn about the quantity and diversity of the customers. So for example, if the customers are more broad or more specialized or niched, like it's better for the risk perspective if the customer base is more broad, but is sometimes if the customer's base is more niche, then it can provide visibilities and comfort regarding future revenues. And end markets. So similar end markets usually share a similar performance outlook because performance is generally tied to economic and other factors that affects its end market. It is important to know that the customers need to be distinguished from the end market because, for example, the housing end market is completely different than like the customers can be retailers, suppliers, or even home builders. They're completely different. Next is distribution channels. They are the avenues through which a company sells their products and services to the end users. They're the key drivers of operating strategies, performance, and values. Some of the distribution channels can be wholesale, retail, online, or direct to customers, and some companies even have several of different distribution channels. And each channels can have different organizational and cost structures. Geography. Different regions of the world can differ in fundamental business drivers and characteristics. Those can be growth rate, macroeconomic environment, competitive dynamics, path to market, organizational and cost structure, potential opportunities, and risk. So those differences can result from factors like local demographics, regulatory regions, consumer buying patterns and preference, and cultural norms. Therefore, bankers tend to group US-based or focused companies in a separate category from European or Asian-based category, even if they business models are the same. Financial profile. We're going to analyze after the business profile. Size are usually measured by business valuation, like equity value, enterprise value, and key financial statistics like sales, growth profile, EBITDA, EBIT, and net income. So similar size in a given sector has similar multiples and therefore similar in respectives like economics of scale, purchasing power, pricing leverage, customers' growth prospects, and trading liquidity of their shares. And the comparables are often tiered based on the size categories as well. Next, profitability means its ability to convert sales into profit. It usually measured by profitability ratios, we call it margin. And we put profit in the numerator, such as gross profit, EBITDA, EBIT, or net income, and sales in the denominator. So usually it means higher profit margins translate into higher valuations. The next is the growth profile. It is a critical driver of valuations because equity investors reward high growth companies with higher trading multiples. They need to figure out if the growth are organic or acquisition driven. And the growth profile are measured by various financial statistics like sales, EBITDA, earnings per share. For mature public companies, we usually use earnings per share growth rate to measure. And for those other companies that are early stage or emerging with little or no earnings, we can not use the earnings per share. Obviously, we use the sales or EBITDA growth for the measurement. The next is the ROI, return on investment. It means the ability to provide earnings or return to its capital providers. It usually has the measure of profitability in the numerator and a measure of capital in the denominator. Some measure of profitability can be EBIT. NOPAT means net operating profit after tax. We also sometimes call it tax effective EBIT or EBIT. EBIT means earnings before interest after tax, or net income can be the numerator. So the measure of capital for denominator can be investment capital, shareholder equity, and total asset. Here are some most commonly used ratios. ROIC is return on investment capital, ROE, return on equity, ROA, return on assets, and dividend yield. The next for the financial profile is the credit profile, which means the creditworthiness as a borrower for the target. It is measured by metrics relating to overall debt level, we call it leverage, and its ability to make interest payment, we call it coverage. It reflects key companies and sector-specific benefits and risk. Here are some mainly credit rating agencies, Moody's, S&P, and Fitch. So after we started the target and identify some key characteristics, here finally comes to the selection of the comparable companies. And first it starts for examination of the target's public competitors because they share business and financial characteristics we discussed before, and opportunities and risk. And for the public target, we usually check their 10Ks, annual proxy statement, investor presentations, and equity research report for their primary competitors. And for the private targets, we can check their public competitors' documents if they have the public competitors, and some other industry report or research report for their public competitors. Besides that, we can also check their merger proxy, which means the proxy statement for relatively recent mergers and acquisition transaction in the sectors. They usually has some fairness opinion for the purchase price or deals term, which is supported by the valuation methodologies for the target, and those valuation methodologies has list of comparable companies we can check. And the other one would be some industry code such as SIC, Standard Industrial Classification, NAICS is North America Industry Classification System. We can use those industry codes to establish a broad initial universe of comparables and ensure no potential companies have been overlooked at the end. We can also check the sector reports published by the credit rating agencies. They can cover some comparable companies. And lastly, you can have a conversation with your senior banker or industry expert to have them have a check because they have more knowledge and experience about it. So thanks for everyone. Here is today's video for the first step of the comps analysis. And next video, we're going to keep doing the following steps. Thanks for watching.